Good morning, everyone. I believe you're doing well. Happy New Year, 2024. It's my prayer that this new year brings good tides on your side. In terms of Forex trading, I want to make sure that you improve your Forex trading journey. And the reason why I've decided to do a free YouTube mentorship for this year, 2024. And we shall be covering a lot of content. But to begin with, I want us to discuss about risk management, because I know you guys are already trading, and what you need is just some information to help you improve your Forex trading. For those who are not yet trading, I have a Forex beginners course in the YouTube. You can go and check from the beginners level all the way to advanced level. So you can watch and begin from there, and then you'll come and watch the 2024 YouTube mentorship. So I want us to begin with risk management. And when we talk about risk management, basically this is where most of the traders go wrong in terms of risk management. This is where greed comes into place, and you tend to over leverage with the idea of trying to get rich quickly. But I can tell you that for sure, Forex is not a get rich quick scheme. And the reason why you need to take risk management very seriously, because it gives you the edge, or it helps you in terms of succeeding, or it gives you the longevity when it comes to Forex trading. Because with risk management, basically the goal is to minimize losses and also to preserve our capital. So let's look at the different example. I have some different examples here of risk management. So the first example is basically risk management or risk 10% risk. Okay, a trader who is taking 10% risk, and also we have a trader who is taking 5% risk. They all starting with the balance of $1,000. Okay, this is very reasonable for every one of us. So you see from the first example, when you're risking 10% of your capital. So from the first trade you take, so these are examples from 9 consecutive trades, and we assume that these 9 consecutive trades are losses, which is very likely to happen in Forex, and especially for beginners, and not only for beginners, even for experienced traders. And if you don't practice proper risk management, you find that you might tend to be struggling a lot. So we have the first scenario. The first trader here takes risks 10% of his capital per position. So the first position, he loses $100. So the capital left here is $900. So he loses 10% of that. That is $90. And the capital left here is $810. So 10% of that, the next trade, he loses $81. So we have $729 left. And then 10% of $729, that is $72.90. So the trader continues to trade, risking 10% per position, and with 9 consecutive losses, so the percentage loss will be 61.25%. And the trader will have lost actually close to $613 around there, $613. So you find that with this kind of risk, it even affects you psychologically, because you can imagine having an account of $100, then you keep losing 10%, and at the end of it all, you have a $387.44 account. So even psychologically, it affects you. It's difficult. It becomes difficult even to try to trade and recover the losses. So the next example here is for a trader who is risking 5% per trade. So you can see the first trade he risks 5% of $1,000, so he loses $50. So he continues like that until he makes the last trade that he loses $33.17. and the overall percentage risk becomes 36.97. So if you compare the two, 10% risk and 5% risk, you find that at least 5% risk, yes, it's on the higher side, but again, from an account of $1,000, and then you are left with 630.28 bucks. At least these you can sit down, recollect yourself, and trade again with the correct risk, and you are able to recoup the losses, and you continue trading with the account. Okay, so the next example we are going to look at is the risk percent, that is 2% risk, and another trader who is risking 1% risk. So with 2% risk, meaning that if you start, this trader starts with $1,000, this trader loses actually 20 bucks for the first trade. The second trade, he loses 19.60 bucks, that is 2% of the remaining capital. Then the third trade, he loses 19.20 bucks. So by the time he's doing the ninth trade, he loses 17.01 bucks, and the amount of capital left is 833.79 bucks, and this is a loss of 16.2% of the initial capital. So this again is very much manageable. It's better compared to the 10% and the 5%, because you see at the end of the 9 trades, consecutive 9 losses, the remaining balance here is 833.79 bucks. So with this trade, or with this risk management, this trader is able to recompose him or herself. He is able to go back to the drawing board and very easy recoup the losses and continue trading in the right manner. Okay, so again, the last example I have here is for 1% risk. So as you can see here, this trader risks 1%. So with 9 consecutive losses, we'll have a loss of 8.64%. And the remaining balance will be 913.54 bucks, which again is very, very much accommodative. It's very much accommodative. This does not even affect your psychological or your state of mind. You're not worried so much because yes, you have lost, but you have lost a lot. You have not lost quite a huge chunk of money that might be able to affect you psychologically. And the reason why now we say that as a trader, when you're trading the first time you're a trader, you're a new trader, or even if you're an existing trader, it's good to always ensure that you practice proper risk management. Okay, it's good to ensure that you practice proper risk management. The rule of thumb is do not risk more than 1 to 2% of your account. Do not risk more than 1 to 2% of your account per position. So as a beginner, it's good to start with the lowest risk, maybe 1%. And as you get exposed to the market, to the Forex market, you can maybe probably increase your risk to 2%. Okay, so this will ensure that you minimize losses and also you preserve your capital. So another key aspect when it comes to risk management is what we call risk to reward ratio. And risk to reward ratio, basically this is what again is able to sustain you in the market for long, because you find that, for instance, the examples I've given here, we have a risk to reward ratio of 1:1, and we have a risk to reward ratio of 1:2. So risk to reward ratio, when we giving this example, let's say we are risking $10. So it means that anytime we make a profit, we are making a profit of 10 bucks. Okay, so with this example here, you can see that we have how many take profits. We have profitable trades. We have 4. We have these 1, 2, 3, and 4 profitable trades, and then we have 6 losses. Okay, so this tells you that with the 4 profitable trades, that is 40 bucks, and with 6 losing trades, that is 60 bucks. So at the end of the day, this trader will have lost 20 bucks because the winning rate is 40% and the losing rate is 60%. But in case of this, the second example, risk to reward ratio of 1:2, meaning that we are risking 10 bucks going for 20 bucks. So you find that with this example, we have 1, 2, 3, we have actually 1, 2, 3, 4 wins. So this means that from the 4 wins, this trader is making 20 bucks times 4. That is 20 bucks. 20 bucks times 4. That is 80 bucks. And with the losses, anytime we recoup a loss, remember we are risking 10 bucks. So we have 6 losses. So that will be 60 bucks. Okay, a loss of 60 bucks. So you have made a profit of 80 bucks and a loss of 60 bucks. So at the end of the day, this trader will be $20 in profit. Okay, so you can see now why risk management or risk to reward ratio is very important for you as a trader. It's always good to take trades that gives you a risk to reward ratio of 1:2 and above, because with a risk reward ratio of 1:2 and above, like you have seen, you can be 60% losing trader and 40% winning rate, and at the end of the day you are profitable. Okay, so the key pointers for novice traders, or what I would always advise novice traders, is proper risk management is the holy grail. Okay, this is the holy grail. I usually say that risk management is the surest strategy in Forex trading. So the rule is do not risk more than 1 to 2% of your capital per position. So anytime you are opening a Forex trade position, ensure that you do not risk more than 1 to 2% of your capital. And again, don't open like multiple positions, like 10 positions, and each position you are risking maybe 1%, because at the end of the day, when you have 10 multiple trades running and you've risked 1% per position of your capital, so at the end of the day, it means that you have exposed yourself 10%. So this means that you take one trade at a time. Once your trade hits take profit, then you can look for another trade setup and you trade. Okay, so it is one trade at a time. So as a beginner, start with the lowest risk, that is 1% risk, until you get mature enough in the market. And again, remember, the goals of proper risk management are to preserve your capital and to minimize your losses. And also remember to practice a risk to reward ratio of 1:2 or above. This means that every trades that you're taking, they must be trades that are giving you a risk to reward ratio of 1:2. That is, when you're risking $1, you're targeting to make $2. And I tell you for free, this aspect of risk management is what has made even experienced traders, mature traders, fail to break even in Forex because of practicing what we call poor risk management. So if you stick to this that I've given you, or what I've shared with you, you'll find that you remain profitable, or you remain in the Forex field for long, and you'll also be able to find an edge. Okay, so despite whether you are good in terms of maybe analyzing charts, you're good in terms of technical analysis, fundamental analysis, but if you miss it in terms of risk management, then you'll find yourself struggling in Forex trading. You'll find yourself being unsuccessful in Forex trading, and at the end of the day, you might be discouraged and quit along the way. And see you in the next mentorship video. Thank you.